Okay, dear students, this is Mustafa Mirchawala from Mirchawala's Hub of Accountancy, and today we are going to discuss the pre-mock for June 2024 attempt, right? And this is available, this mock is available on ACCA website as well. So you can access this question from ACCA website, right? Okay, right? Now, just for your motivation, sharing some recent scores, you can see this is list 1, and we have this time highest marks of 97 from Pakistan, and this guy got like a second position in the world and first position in Pakistan. Then we have one more position holder, that lady Hira, from Qatar, F7 top, right? Oh, sorry, Saudi, it's Saudi. Then lot of students you can see with different nationalities. So they all scored excellent, and this is a big number, right? Okay, so when they can score, why can't you? They have also studied the same course with the same teacher. They just followed the instructions. They were all confident, I would say. So if you follow that things, you read articles, if you have read the study text, yes, I also recommend reading study text of IAS IFRS. So you guys can also do it. Okay, so now today we are going to discuss that consolidation part of that mock. Yes, it is achievable if you have taken the classes. If you are consistent, if you are focused, you can do it. Okay, let's start. So now, first of all, in consolidation or in financial reporting area, you always see the year end. So your accounting period is 30th September 20x3. Be careful with this number, okay? 20x3. Now, on 1st June, January x3, this is the takeover date. This is the takeover date. Now they are saying on 1st January, Persistent Pharma, Persistent Pharma means parent company, acquired 80%. Yes, this is relevant information of the equity share capital of Smart Pharma. This is subsidiary. The share capital of Smart Pharma consisted of 7 million ordinary shares. That means subsidiary company has issued till now 7 million ordinary shares. 7 million ordinary shares, right? Okay. Now, first of all, if you see the year end, this is the year end and this is the takeover date. Okay. So the gap between this is a sort of part year acquisition. This is the topic of part year acquisition. Like, that means the difference between acquisition date and the reporting date is 9 months. You can see the 9 months difference. Okay. One more thing. Subsidiary company has issued 7 million. 7 million in our words, it's 7,000 shares. And out of 7,000, how many shares we have bought? We have bought 80%. We have bought 80%. So 7,000 multiplied by 80% is 5,600. Parent company has bought 5,600 shares of S company. Be careful with this. Now, let's discuss the cost of consideration. Persistent Pharma company settled the consideration by issued 2 new shares in exchange of every 5 shares acquired. Every 5 shares, for every 5 shares we are issuing, see, for every 5 shares of S company, we are giving 2 shares of P company, 2 shares of P company. So you know how to make the fraction. It will be 2 upon 5. 2 upon 5. We'll write the shares of S company in the denominator, and the shares which are going to give up by the parent company we'll write in numerator. So 2 upon 5. Okay. So if I want to calculate the shares consideration, if I have to calculate the shares consideration, it will be, wait, from S company we have bought 5,600 shares, multiply by 2 upon 5. 5,600 into 2 upon 5. So it will be 2240 shares. 2240 shares. Okay. That means parent company is giving 2240 shares as a consideration. And what is the fair value? What is the price of per share? What is the price per share? It's $6.5. You can see the one share of parent company is $6.5. So if you multiply it by $6.5, you will get shares consideration. Don't worry, I'll teach everything on the Excel as well. Right now I'm just doing rough working, like, so it will be, this is your 14560 is your shares consideration. 14560 is your shares consideration. Okay, now the next thing, also a further consideration was payable on 31st December X4 at $3 per share acquired. Means the takeover date is 1st January X3, but we promised to pay them after 2 years. After 2 years, how much? $3 per share acquired. $3 per share acquired. So this is basically deferred consideration, unconditional promise to pay cash. Okay. So what we do with deferred consideration, you better know, we do discounting. We do discounting. Okay. So it should be done like this. Listen. This is 1st of January X3, the takeover date. And after 2 years, like 31st December X4, 31st December X4, you have to pay, how many shares you acquired? 5600. You acquired 5600 shares. Okay. So 5600 multiplied by 3 you have to pay. So 5600 multiplied by 3 will give you, I think, 16,800, something like that. Yes. Now you have to do discounting. So how to calculate present value? This is the 16,800 multiplied by, discount rate is 10%. So 1 upon 1.1. Why 1.1? 0.1 means 10%. 1.1 power 2. 16,800 into 1 upon 1.1 power 2. The gap is 2 years. The gap is 2 years. 13884. The present value is 13884. Okay, 13884. With this present value, you normally make the first entry: debit investment, debit 13884, and deferred consideration DC credit 13884. Investment debit and deferred consideration credit. Okay, investment debit and deferred consideration credit. Okay, now one more thing you have to, this is the part of COI. Then debit investment mean this is the part of COI. Now one more thing is that you have to calculate unwinding of discount, the interest expense thing. And yes, my dear student, your year end is 30th September X3. So between acquisition date and year end, there is only 9 months. So my respected student, just 9 months interest you have to book. So 13884 is the present value. 13, you know how to calculate unwinding of discount. 13884 multiplied by 10% into 9 upon 12. 13884 into 10% into 9 upon 12. Let me do it. It's 1041. Yes. So your interest expense is equal to 1041. Okay. And as this is the question of income statement, so this interest expense will be part of finance cost. Why? Because parent company, just think over it, parent company promised to give this amount. So this is the loan of parent company. That's why this interest expense belongs to parent company. So it will be purely added in the income statement of finance cost, and it has no link with NCI. It has no link with NCI at all. Okay. Right. So we have calculated total COI. This is one COI. And this is the another one. Okay. Don't worry, I'll be doing it on the Excel, just right now giving you idea. Now, the next thing for goodwill, the first requirement is goodwill calculation. See, calculate the goodwill at the date of acquisition and at 30th. Two requirements. It's 4 marks basically. The typist forgot to write the marks, so it's 4 marks. Okay. So we have to calculate goodwill at acquisition date as well as at the reporting date, because there will be some impairment as well. So my dear student, uh, in full goodwill method, as this is the question, as this is the question of full goodwill, I'll tell you the policy, right? As this is the question of full goodwill method, so that's why we need fair value of NCI at acquisition. We need fair value of NCI at acquisition. Okay. Now wait. Sometimes, listen very carefully. You have done these things in class. Sometimes examiner gives you ready-made fair value of NCI at acquisition. But sometimes you have to calculate fair value of NCI through S company shares, through the NCI shareholdings, okay, and the share price. So, can you see the screen? They are saying, see this, and that of Smart Pharma was for $4. See, the share price of Smart Pharma was $4 per share. So wait, dear students, this is P company, this is S company. So P company is holding like 80% shares, and NCI has, so NCI has 20% shares. Very simple. So S company has issued total 7,000 shares, and out of 7,000 shares, out of total 7,000 shares, how much shares NCI has? 20%. So 7,000 multiplied by 20% is 1,400 shares. So NCI has 1,400 shares. NCI means 1,400 shares in this company, in this question. So NCI means 1,400 shares of S company, multiplied by the per share price is $4. So 1,400 multiplied by 4 is, I think, 5,600. This is your fair value of NCI. This is your fair value of NCI at acquisition. I'm sure you all guys know this. You all guys know this about fair value of NCI. Okay. So yes, what we have calculated till now we have calculated COI. Yes, both types of consideration, fair value of NCI at acquisition. But one thing is left, and that thing is less fair value of net assets of S company at acquisition date. We have to calculate the packet of fair value of net assets at acquisition date. We'll do it, don't worry. We'll be doing it. First of all, we know that your share capital is 7 million. The share capital of S company is 7 million. Don't forget this. And do remember this year end. Do remember this year end, and do remember this takeover date. Okay. Three things are important. I'm sure you all have done the basics class. Now, this is, my dear student, this is the profit of S company for the whole year. This is the profit of S company for the whole year. Now, on 1st January X3, very simple things. Fair value of Smart Pharma's companies was equal to their carrying amount with the exception of the following. Listen, an item of plant that had a fair value of 4 million in excess of carrying amount. So it's upward fair value adjustment. Upward fair value adjustment, you better know. So we'll write C is equal to A minus L. At one end, you will increase the asset by 4,000, on the other end, net assets. But in this question, there is no SOFP. So only we'll use this in the fair value adjustment net asset packet. So in the net asset packet, we'll add 4,000. We'll add 4,000. Okay. Now one more thing. On that date, its remaining useful life was 4 years. Yes. So, and depreciation is charged to be cost of sales. So I hope you remember about excess depreciation of fair value adjustment. Yes, it's a very famous topic. So how to calculate excess depreciation? Simple. The revalued amount, the 4,000 is the extra amount, divided by 4 years. So it's 1,000 per annum, 1,000 per annum, because divide by years. Okay. But there is only 9 months. There is only 9 months gap between acquisition date and takeover date. So yes, you need to apportion it by 9 upon 12. So this is going to be 750. Okay, so this is the excess depreciation of this question. Now listen to me very carefully. Basically, except for this first requirement, this question is all about income statement. So can you guys tell me what is the treatment of excess depreciation of upward fair value adjustment? What is the treatment of excess depreciation upward fair value adjustment? The treatment is this excess depreciation will be added in consolidated cost of sales. This excess depreciation will be added in consolidated cost of sales, and then finally at the time of the calculation of NCI we need to subtract this excess depreciation from S company's profit after tax in order to calculate NCI. Okay, you know all these rules and steps, and I have given the logics in my classes as well. You guys better know. So don't forget about the excess depreciation posting. It will be added in cost of sales and it will be subtracted in the calculation of NCI. Okay, now the next thing, these changes were not recorded by smart company. It's okay, this is very routine thing that S company does not know about fair value adjustment. S company does not know about fair value adjustment. Okay, now there was a very famous, once again famous adjustment. There was a contingent liability of 2,350,000 which had a fair value of 125,000. Yes, now this is a very famous case. Listen, when parent company acquires S company, and if there is a court case on S company and there is a contingent liability note, there is a disclosure. If there is a disclosure of contingent liability note in S company's individual books, so as per individual books it's perfect, but for the purpose of consolidation, we need to give birth. We need to recognize this contingent liability at fair value. Okay, so this will be treated as fair value adjustment liability. So in very simple words, this is your C is equal to A minus L. So yes, you will recognize this liability by the fair value of this liability is 125. Okay, I'm not writing 3 zeros. So when liability goes up, your net assets goes down. Okay, your net asset goes down. So in the net asset packet, this will be written as a negative number. In the net asset packet, this fair value of contingent liability will be treated as a negative number. Be careful, because I'm just discussing question right now. After this discussion, I'll shift myself to the Excel sheet where I won't be able to show you the question, right? Now they are saying this had not changed on 30th September X3. There is no changes, so no more post period expense or income. Okay, so yes, we have done the fair value adjustment things, but one thing is left. Listen, we have to calculate acquisition date packet. See, acquisition date net assets of S company. Just don't sleep. Ordinary share capital is simply 7,000, right? Because S company has issued 7 million shares. So ordinary share capital is 7,000. Now retain earning, this is very interesting. They have given you, retain earning. Yes, point number 3, let me enlarge. They have given you retain earning on 1st October X2, the beginning of the year. They have given you retain earning of 1st October X2, that is 12 million. Now relax. And your takeover date is 1st January X3. So there is a 3 months gap between these two. Listen. This is 1st October X2, the beginning of the accounting period. The end of the accounting period is 30th September X3. 12,000 is the retain earning here. And listen, your takeover date is 1st of January X3. My dear student, for this whole year, S company's profit after tax, use your brain. See the income statement. For this whole year, S company's profit after tax is 4065. For the complete accounting period, it's 4065. So if this accounting, if this is 4065 for the whole 12 months, for the whole 12 months, so you need to do 3 upon 12. You need to do 3 upon 12 in order to calculate profit for 3 months. See, for the complete 12 months profit is 4065. So let's do calculate for 3 months. So it will be 1016.25, 1016.25, 1016.25. Okay, so what you will do, opening retained earning is 12,000, you will add 1016.25, so it will be, see, retained earning is 13,016.25. Okay, so this is the retained earning at acquisition date. This is the retained earning. We just did the forward working. We just did the forward working, my dear students. I hope you got it. Yes, it's a routine thing. So now what they are saying, it is the policy of persistent pharma to value non-controlling interest at fair value. Yes, it's a full goodwill method. I have already told you, full goodwill method. Okay. So in my eyes, we have almost done everything for goodwill. We have calculated COI, both type of consideration. Yes, we have calculated fair value of NCI at acquisition. We have calculated fair value of net assets packet. Yes, because we have ordinary share capital. We have retained earning. We have already just calculated retained earning at acquisition date. And yes, we have already discussed the two fair value adjustment. One is plant and the other is contingent liability. So my dear students, you can easily calculate goodwill now. Okay, I'm going to solve it in Excel, don't worry. Now, before we read point number 4 and 5, just read point number 7 first. Point number 7 first. What they are saying? They are saying goodwill was impaired by 25%. Goodwill was impaired by 25% by 30th September X3. So whatever goodwill we are going to calculate now, we'll impair it by 25%, and after deducting that impairment from our normal goodwill at acquisition date, you will finally get goodwill at 30th September X3. You will be finally getting goodwill at 30th September X3. Now one more thing, as this is the goodwill impairment of goodwill of full goodwill method, as this is the impairment of goodwill of full goodwill method, so income statement, in the income statement it will reflect two areas. Number one, it will be added in consolidated admin expenses. It will be part of consolidated admin expenses. And number two, as it is impairment of full goodwill method, so in full goodwill method, NCI also has to bear the burden. So sorry, this impairment will be deducted. From S company's profit after tax in the calculation of NCI. Okay, don't worry about it. Now few small transactions are left. Yes, one is S2P sale of inventory. My dear student, honestly, these types of transaction we do in F3 FA level, the basic level. Okay, knowledge level. So during the post acquisition period means 9 months. Okay, from 1st January X3 to 30th September X3 is the post acquisition period. Smart Pharma Company, S company sold goods to P, S2P at a rate of 250,000 per month at the gross margin of 25%. Right? So first of all, can you calculate 9 months sales? Yes, it's very simple. 250,000 is it's per month sale, multiply by 9 months. So 250 multiplied by 9 is 2250. So 2250 is the total sales of 9 months between S to P. Between S to P. Now hold. S to P, the sale is 2250. Now, can you tell me the steps? This is the sale of last 9 months. Okay, the exactly already apportioned sales between S to P. Now, what is the first step of S to P sale? In the income statement, the first step is whatever amount of sales you have done, you need to deduct this 2250 from consolidated sales and consolidated cost of sales. From consolidated sales and consolidated cost of sales, you need to reduce this amount of transaction. Now the next thing is URP, unrealized profit. Very easy. See what they are saying. They are saying goods worth. Now this part will give you URP. This part, goods worth 300,000 were included in the inventory of persistent pharma. Okay. Now at the year end, out of this 2250, 300 goods is still in the inventory. Now these 300 is a cost for P company, but it's a selling price for S company. These 300 is a cost for P company, but it's a selling price for S company, and S company charges 25% margin. Margin means profit percentage on sales. So S company charges 25% on their selling price. So simply directly multiply 300 multiplied by 25%. This 75 is your URP. This 75 is your URP. Now can anybody tell me what are the three steps of S to P sale? What are the three steps of S to P sale? S to P sale. The first step is whatever is the amount of transaction between S and P, so reduce it from consolidated sales and consolidated cost of sales. First step. Second step, this URP of 75 will be added in the consolidated cost of sales. And the third step is this URP will be deducted from S company's profit after tax, in the calculation of NCI, okay. This is how we'll do it. Okay, so now the last point is uh, it's IFRS 9 convertible loan notes. Those who issue convertible loan notes, they have to book debt and equity both. Okay, so on date, now see the dates are very very important in financial reporting. On 1st October X2, the beginning of your accounting period, persistent pharma. Now this transaction is not related to consolidation. This is normal parent company's transaction. And believe me students, whenever a transaction is solely related to parent company, that means that transaction has no link with NCI. That transaction has no link with NCI. Okay, so on 1st of October 02, Persistent Pharma company had issued $3,000 1,005%. This is the coupon rate. See, the percentage written with the loan note is always coupon rate, physical interest. Okay, so you can easily calculate the physical interest. Okay, right now. Loan notes, the interest is payable in arrears over a 5 year. See, this is the period, the 5-year period. So you will get 5-year physical interest, 5-year physical interest, and at the end of the 5 year, you will have option to take cash or shares, convert into shares. The interest rate for the equivalent non-convertible loan, convertible notes was 7%. See, this is the market rate. This is the market rate without conversion. Persistent Pharma Company had recorded wait. Persistent Pharma Company had recorded the liability at par value. At par value. That means they have not distributed. They have not distributed between equity and loan. This is the routine issue. In final account question, you have also seen this. Now, and recognize interest payment at the rate 5% for the year. That means yes, they have already booked. They have already booked the physical interest. But you have to book according to this market rate. Okay, so first of all, they have only recorded the liability at par value, but the rules of financial instrument, you need to divide this between equity and debt. And what are the rules? The step number 1, first of all, calculate all future cash flows and treat this transaction as a pure loan, right? The all future cash flows are physical interest and the principal amount. Now you need to do discounting. So for discounting, you need this 7% rate. You need this 7% rate. Okay, always market rate. So this column is totally irrelevant, totally irrelevant. This column is also totally irrelevant. See, this is the normal habit of examiner. They give you irrelevant data in the question. Okay, so 7% is only relevant now, and your term is 5 years. So this is also irrelevant. 2 years is irrelevant. This is irrelevant, and this is also 2 years. 2 years factor is irrelevant now. Yes, this and this is relevant now. Discount factor in year 5 is 0.173, and annuity factor because on interest there are 5 interest payment. So for interest we have to use annuity. Okay, so now can you use your brain? 3000 are the number of loan notes, and the price of one loan note is 5%. So can you calculate physical interest of one loan note? It's 1000 multiplied by 5% is 1000 multiplied by 5% is 50. 50 multiplied by 3000. 50 multiplied by 3000 is 150,000, and if you remove 30, it will be 150. So wait, present value of interest payments, one thing, and then present value of principal amount, two things. Okay, so 150 is the interest, and yes, there are total 5 interest payments, so definitely we'll apply annuity factor. We'll be applying annuity factor, which is 4.1, and the principal amount is going to be 3000 multiplied by 1000 is 3 million. So with 3 million, if you remove 30, it will be 3000. So 3000 multiplied by a single discount factor is 0.173 in year 5, 0.173. So you need to add both of them. Okay, so this is present value of liability element. Now one thing, be very smart. This question is not a balance sheet question. This question is not a balance sheet question at all. So you don't need to show difference between equity and debt and all. That's all rubbish. Just you calculated present value of liability element, and now on this present value, this let us say this is 1st October x2, and this is your first year end 30th September x3. Use your brain. So this is your liability element, which is 1134, and now you use 7% to discount, 7% interest to discount this. The same 7% you will be using for unwinding. My very famous dialogue. the interest rate which is used for discounting, the same interest rate is to be used for unwinding. So 1134 multiplied by 7%, 79.3. So the entry will be interest expense debit 79.38 or 4 17. Physical interest is how much? The physical interest, wait, there is some, wait, wait. Okay, so I've just checked with the original question. This is not 0.173. This is the typing error. Okay, this is not point. My typist copied it wrong. It's 0.713. 0.713. You can check from the original question which is available on ACCA Global. Okay, ACCA website. It's 0.713. So that's why this number is wrong. Okay, 0.713. It's 0.713. So 3000 multiplied by 0.713 is equal to 2139. Yes, 2754. See, this is 2754. Now you will get correct answers. So 2754 multiplied by 7%. 2754 multiplied by 7% is, yes, 192.78. Now how much is the physical interest? It's 150, and the difference is to be booked in loan, that will be 42.78. 42.78. I hope you remember the double entries. Okay, now can you tell me how much already booked, how much interest already booked by this parent company? Only 150. They are saying only 150 is booked. So extra interest you need to book is 42.78. This will be added in finance cost. This will be added in finance cost. Now I have one small question from you guys. Just think, this loan was taken by parent company. This loan was taken by parent company. So that's why this whole interest expense belongs to parent company. So this will directly hit your consolidated finance cost, and as it will directly hit consolidated finance cost, so it has nothing to do with NCI. Okay, so 42.78 will be added in consolidated finance cost, the extra element. See, they have already recorded 150. Let me show you. Wait, these wordings, see. Okay, you can see it is written that persistent pharma company recorded the liability at par value, and recognized the interest payment at 5%. That means the physical interest has already been booked. Okay. Okay, so I would request you, all the requirements have been done. Now see the requirement number B. Prepare the consolidated income statement, profit and loss for the year ended 30th September X3. Now you guys are excellent people. You know, in this whole 30th September X3, parent company for the whole year, parent company belongs to us. So we'll add complete amount of parent company. Okay, but In subsidiary company only 9 months because subsidiary company was taken over on 1st January X3, so only 9 months we have control in this accounting period. And as we are preparing income statement, so income statement always reflects for the year things, for the year conditions. So parent company data, sales, cost of sales, everything complete, full, and S company only 9 months, 9 upon 12. Okay, same is the case with NCI. When we will be calculating NCI for income statement, we have to take S company's profit after tax of 9 months. Okay, now I would request you to take the picture of the question if you guys want, because I'm going to move the screen. So this is the question. If you want to take the picture, because I'm going to move the screen, but yes, I have question with me on the other screen. Oh, but only I will be able to see, you guys won't be able to see now. So take the picture of the question. If you want to read the question, I can give you time, please. Because now one more thing, I have explained you the question. See, this is the income statement, I'm going to use it. Okay, I have explained you the question. Now on the Excel side, now I'm not going to explain you, I'll try to type and do it. Okay, this was the error in the question, 0.713. Okay, my typist wrongly copied it, but I have corrected it. It's not 0.173, it's 0.713. That's why I was shocked why the numbers are different. See, these are the requirements, and there is the third requirement as well. When valuing, this is a different requirement. When valuing the non-controlling interest at acquisition under IFRS 3 business combination, there are two methods. Yes, we know there are two methods permitted. One is full goodwill method, the other one is proportionate method, right? Discuss, see, this is the requirement, last requirement. Discuss how the initial calculation and subsequent treatment of goodwill arising on the acquisition of Smart Pharma Company would have differed had the non-controlling interest been measured using the proportionate share of the identifiable net asset at the acquisition date. Show calculation of revised goodwill. Easy. So you need to calculate goodwill again using proportionate method in requirement C. And you need to explain the treatments as well of both. Okay, so I'm sure you have taken the pictures. See, now I'm going to move the screen. You have taken the pictures. Okay, okay, so now we have this format with us, but first thing I would like to tell you that in the examination you won't be getting these written stuff. I have written it before just to save my time and your time. Okay, right? So first of all, the first 4 mark requirement is the goodwill calculation, right? So there are, first we need to calculate the consideration which we call COI, and there was a shares consideration. So how to calculate shares consideration? Yes, 7,000 multiplied by 20%. We have taken 5,600 shares, 5,600 shares from them, into multiply by 2 divided by 5. Hope you remember the deal. 2 upon 5 into the share price. The share price was 6.5. The share price was 6.5, right? Okay, so let me write this here. It will be equal. Now be relaxed and just try to understand. 5,600 into 2 upon 5 multiply by 6.5, right? It's going to be 14560. The second thing is you need to calculate the deferred consideration. Now I have already done the calculation with you, just writing here. So for deferred consideration, 5,600 shares multiply by 3 pounds, this is the future cash flow, into 1, into bracket open, 1 divided by 1.1. Wait, let me do it like this, into 1 divided by sorry, 1.1 divided by 1.1. Okay, right? So this will be the present value, 5600 into 3 divided by 1 upon 1.1 into 1.1, right? Because 1.1 power 2. So this will be how much was this? It was 13877, 13877, 13877, right? So this is your total COI, the total COI. Now the next thing was fair value of NCI, fair value of NCI. Remember, the total number of shares issued, the total number of shares issued by, the total number of shares issued by S company was 7,000 shares, and NCI guys had 20%. So it will be 7,000 multiply by 0.2, 20%. And what was the share price of S company? It was 4. So this is going to be equal to 7,000 into 0.2 into 4, 5,600. Now the next thing is interesting. Less fair value of net assets, fair value of net assets. Now let's do the working. We need to do working for this. So let's move the screen. Yes, this is the working. So here we have share capital first. We have share capital of how much? 7,000, right? Then opening retained earning at 110 x2 means 1st October x2 was 12,000. Then you have profit for the 3 months. You need to add the profit of 3 months. So complete year profit will be 4065, 4065 into 3 divided by 12. So this will be equal 4065 into 3 upon 12. Okay, now fair value adjustment plant was 4,000 positive, and yes, because of contingent liability, when liability increases your net assets goes down. So the fair value of contingent liability is 125 negative. So let's add it up. So let's add net of these two, 3875. Okay, so if I add all of them, yes, 23891.25, this is fair value of net assets. Okay, and the cell number is F49, F49. Okay, so this is your fair value of net assets. Wait, you need to deduct it, so that's why it will be equal negative. Okay, right, now let's calculate the goodwill. One zero one four five, 10145. Okay, 0.75, or you can write as 10146. Now how much is the impairment for the 9 months? 25% was the impairment. So let's deduct the impairment of this into 0.25, 2536.4, or you can call it 2.537. So how much is the goodwill after impairment? It's 7609, 7609. Okay, so finally you have done the 4 mark requirement. I have already explained you this requirement. In my iPad thing. Now just solving it. Okay, now be active. Now before we start the income statement thing, before we start, my dear student, the income statement thing, first let's do some workings, and the workings I have already covered you in the iPad, but still I have to solve it here. So yes, there should be some working for depreciation of fair value. Remember, the increase in fair value was 4,000. Yes, and estimated life is 4 years. So depreciation for 9 months will be 4,000 divided by 4. This will be 4,000 divided by 4 into 9 divided by 12. Okay, 750. 750 is your depreciation. We already know. We have already done it. Okay. Now, one more thing. We just did this thing. We just did this thing. So cash flows were for the convertible loan note, cash flows were, interest was 150, and what was the discount factor for one with 150? It was annuity factor was 4.1. Okay, remember. Then for the principal it was 3,000. Yes, there was a mistake here, into point 3,000 into 0.713. Okay, so let's do it. It's going to be 150 multiplied by 4.1. Then we have equal 3,000 multiplied by 0.713. Okay, so what will be the liability component? 2754. Now I can understand there are some students, they are very sharp and they have understood everything in that lecture which I just gave. There are students, everybody is different. Okay, so they might feel that this is very easy thing, typing and all, so it's okay, they can do this part themselves as well. Okay, I've already discussed the question, but still I will solve it complete, because I have to see the whole big picture, all students. Okay, now 27454 is the liability element. Now how much interest to be charged to PNL? 7%. So equal to this amount into 0.07. Okay, 192.78 less interest already charged, physical interest was already charged, that was 150. So additional amount of interest to be charged is 42.78. I hope you remember it. I just solved with you. Now one more thing, unwinding of discount for deferred, remember, for 9 months. So the deferred consideration was, let me copy, the deferred consideration was 13877. Okay, and I'm sure you remember we have to calculate 9 months only, from 1st January x3 to 30th September x3. 9 months unwinding of discount. So equal this multiply by 0.1, that is 10%. 10% into 9 upon 12, 1040.775, or you call it 1041, as you wish. 1041 you can also write. Okay, so this unwinding of discount will be added in consolidated finance cost. Okay, then one more thing, post acquisition sale. Okay, in 1 month they sold, after post acquisition period, in 1 month they sold 250 sale. So this will be equal 250 multiplied by 9 months, 2250. And what is the unrealized profit? It was 300 multiplied by 0.25. I have already equal 300 into 0.25, 75. This is your URP. Okay, now if you want, I can calculate income statement NCI now, so that we won't have to work hard that much. So for income statement NCI, because we have already done the part 1 4 mark requirement, we have already done goodwill. So for income statement, my dear students, for income statement NCI, we normally take S company's profit after tax. So S company's profit after tax was 4065. Complete year profit after tax was 4065. 4065 is for 4065 is for the complete year. So first make it 9 upon 12. Okay. So this will be equal 4065 into 9 divided by 12. 3048.78. Now, as there is S2P sale, so you need to subtract the URP. URP was 75. Unrealized profit was, I think, 75. Yes. Okay. Then you have extra depreciation. Excess depreciation was, wait, excess 750. Yes, excess depreciation will be deducted from here, 750. Then goodwill impairment. Yes, goodwill impairment was equal to minus, it was, I think, 2536 point something. Okay, wait, let me subtract it. Okay, now, so finally your adjusted profit is negative 312 point something. So how much is the NCI share? Equal to this multiply by 80% is the parent company, so 20% is NCI. So 60 minus 60, NCI is a negative number, okay, minus 62.5, minus 62.5, or you call it 63 as well if you want to round off, no issue. Okay, so this is the calculation of NCI. Just take 1 minute or 30 seconds to check this calculation. See, before making income statement, I am solving the NCI for income statement. Okay, before making the income statement. So now I'll be using this figure directly. Now, my dear students, obviously, we are going, let me highlight it. Okay, wait. We are going to make income statement, but don't forget these things. Listen. For income statement, first of all, complete data. Parent company is with us for the whole year. We are the owners, but for S company only 9 months. Okay. So first of all, revenue. So revenues are 45,000 for parent company complete, plus 27,000 into 9 divided by 12, and see the 9 months revenue. And this, yes, there was S2P sale, so subtract 2250 from here, okay, let's do it here. So this will be equal 45,000 plus 27,000 into 9 upon 12 minus 2250. Yes, 1642. There is some mistake. Wait. Nine upon 2. Sorry, I have written 9 upon 2. There is a mistake in the formula. Wait, it's 9 upon 12. Okay, 63,000. I just wrote 9 upon 2. It's 9 upon 12. Okay, now cost of sales. First, use your brain. See, I have to give cost of sales. See, I am solving it on the spreadsheet. Listen, I have to produce a negative number. Cost of sales is deducted, so already I want negative number. So I'll use opposite sign. Right? So I'll use a standard negative sign for all numbers. Standard negative sign for all cost of sales. So what is the parent company's cost of sales? It's minus 24750 for the whole year. Then we need to add 9 months. So add means subtract here. Minus plus. So minus, how much is the for the S company? 18,900 into 9 upon 12. Then URP will be added in cost of sales. If you remember, URP will be added in cost of sales. So again, same minus sign, 75. Yes, excess depreciation of upward fair value adjustment is also added in cost of sales, but yes, one thing is 2250 we need to remove. So I'll use plus sign. I'll be using plus sign with 2250. Okay, just use your brain. Why I'm doing like this? Because I need a negative number in the end. But if you don't want my style, then use positive sign with all other numbers except 2250, and then in the end multiply it by minus 0.1, minus 1. So this will be equal to 750, then minus 18,900 into 9 upon 12, then minus 75 minus 750 plus 2250, 37,500. Okay, so see, I have got cost of sales, negative number of cost of sales. One more idea, listen, don't worry about it. If your cost of sales is coming a positive number, simply apply the subtraction formula, 63,000 minus 37,500. Okay, but I'm going to apply some formula, that's why I'm writing. I have done like this. Okay, so this is gross profit. Now the next thing is sales and distribution cost. What is the sales and distribution cost of parent company? Wait, it's going to be, once again we need a negative number, so minus 1115, again minus, because we need to add 1325 for S company into 9 upon 12. Okay, so this will be 2109. Okay, I'm writing ready made. Again, now admin cost. Wait, admin cost for parent company is minus 2650. For subsidiary company is 1660 into 9 upon 12. Now one more thing, hope you remember my lecture. There was some impairment of how much? Impairment was 2537, and impairment should be added, means use negative number, minus 2537. Okay, so wait, if you just net it off all of them, this will be minus 6432. Now my dear student, finance cost, it's very interesting. Some things we have to post, like quick listen, unwinding of discount of deferred consideration, and the second thing is convertible loan note interest. Now how much is the parent company? How much is the parent company's finance cost? It's going to be 300, I think. So minus 300, and there is no, if you see, there is no finance cost for S company. Okay, there is no finance cost for S company, but yes, there were some adjustment. What were the adjustment? Let's think. How much was the interest? For unwinding of discount? Unwinding of discount amount was 1041, and for the extra interest was 42 point something. You can write 43. Extra additional interest of convertible loan note is 43. Just to make it whole number, we are rounding it off. Okay, so the finance cost will be 1384, right? You can apply the formula 1384. Now let's calculate the profit before tax. This gross profit, and you net off all these, so it will be 15575. Now income tax expense, parent company's complete tax expense will be there, so this will be minus 2285, and for subsidiary company 9 upon 12, so minus 1050 into 9 divided by 12. Okay, so you will have a number of 3073. You can better check. So now what is your profit after tax? 12502. 12502 is your profit after tax. Okay, and you know what we call it? Listen my words. You are just doing adding together. You are just doing adding together as if you own everything, but the reality is your holding is only 80%. So hope you remember the income statement and P&L of consolidation. In the end, when you complete everything, you have to write 3 lines. You have to write 3 lines, my dear students. You need to write 3 lines, my dear students. Let's do it. See, profits attributable to equity owners of P company NCI, and then total profit. Okay, how much is the total? Wait, how much is the total profit? The total profit is 12502. It's 12502. This, and NCI, now it's a negative number. NCI is a negative number now. It was, I think, 63. NCI is a negative number, 63, 62 point something, but I'm rounding it off. Just for the cleanliness. Okay, so it's 63. So hope you remember the normal classes. If NCI would be a positive number, so you need to subtract 1250 minus 63. If in normal circumstances, when NCI was a positive number, you always subtract 12502 minus 63, but this time NCI is already negative, so 12550 you will have to add 63, so this will be 12565. 12565. That's the end of your income statement. That's the end of your income statement. Okay, right. Let me move the screen so that you can see this. The whole calculation. The starting point, this is all goodwill. This is your shares consideration, then deferred consideration, then fair value of non-controlling interest. Okay, then you have less fair value of net assets of S company, definitely working we have done. This is goodwill, and this is 9 months impairment, which is 25%. Okay, so finally the goodwill after impairment is this. Then we have this income statement in front of you. We have this income statement for you guys. Now finally a very small requirement. See, these all are workings. Still you can see these all are workings. Definitely I have covered all these things on iPad as well. Now one requirement I would like to do. Requirement C. Okay, now as you know, there are two types of methods for the goodwill calculation. Remember, in full goodwill method, goodwill is recorded as a complete asset, that is 100%, with NCI share as well. That's why goodwill impairment in full goodwill method is shared with NCI as well. Okay. In full goodwill method, goodwill is recorded 100%, right? With NCI share as well. And obviously, when the goodwill is 100%, so NCI is also given the share of impairment of goodwill. But in proportionate method, goodwill is recorded till the extent of holding percentage of P company with no NCI share in it. In proportionate method, proportionate method, NCI is recorded as S companies multiply NCI holding percentage. Okay, remember? And for goodwill impairment, no share is given to NCI. All goodwill impairment to be booked in consolidated retained earnings. Hope you remember. Now, calculation of goodwill using very easy now, proportionate method. Be confident now, be confident. You guys are, you have to give paper just after 15-20 days. So be confident. So first of all, write COI, and you have shares consideration. Now I will just copy paste. Okay, shares consideration and deferred consideration. See, I will just copy paste. Now what is the shares consideration? Equal to, let me go up, 14560, and then deferred consideration is F7, the share number F8, sorry, F8 equal F8. Okay, this is deferred consideration. Now COI less, now there is no NCI. The way in which I teach, you just have to write less fair value of net assets of S company. Okay, now how much was the fair value of net assets? I think they were 23891. Yes, we calculate 23891. So it will be 23891 it will be 23, wait, so now fair value 891 multiply by 80%. Simple. 23891 multiply by 80%. 23891, let me see, multiply by, yes, 23891 multiply by 80%. So equal to minus 23891 into 0.8, 19112.5. Let's calculate the goodwill, and you got the marks. 9324, 9324, 9324, 9324. Yes, perfect. This is your goodwill. Okay, so this is requirement number C, this is requirement number C. So not difficult. You must remember the rules. You must be confident. You must trust yourself that yes, you can do. See, then what's the problem? Okay, so I'm sure you did this mock correct, this question correct when you were solving it. Okay, because at first instant you should do it yourself. And if you like this question, if you get some value from this question, please comment on my YouTube channel, okay, on this video. Thank you and take care.